Hello, everyone. Welcome to the Monday, August 18 market opening bell, your 10-minute guide to the stock market. The US Russia summit failed to reach a ceasefire agreement for the Russia Ukraine conflict, which was widely expected. However, US President Trump's announcement that no tariffs will be imposed on China for purchasing Russian oil is positive news. On the other hand, Trump indicated that cheap tariffs could be introduced within the next 2 weeks, potentially rising to 200% or even 300%, putting pressure on US stocks, particularly chip makers. Last Friday, the Philadelphia Semiconductor Index fell over 2%. The Dow Jones Industrial Average rose as much as 292 points to a new intraday high of 45,203, but closed up only 34 points or 0.1% at 44,946, falling short of its all-time closing high of 45,014 set on December 4th last year. The S&P 500 fell 18 points or 0.3% to 6,449, while the Nasdaq dropped 87 points or 0.4% to 21,622. For the week, the Dow gained 1.7%, the S&P 500 rose 0.9% and the Nasdaq increased 0.8%. The Nasdaq Golden Dragon China Index, reflecting Chinese stocks, rose 56 points or 0.7% to 7,641 at close. Cheap stocks broadly declined. Nvidia fell 0.9%, Applied Materials plummeted 14%, Broadcom dropped 1.6%. Qualcomm slipped 0.15%, AMD fell 1.9%, and Micron declined 3.5%. Reports suggest the White House is considering using CHIPS Act funds to invest in Intel to support the struggling chip maker and bolster U.S. semiconductor production, leading Intel to rise 2.9%. Other tech giants show mixed performance. Meta gained 0.4%, Apple fell 0.5%, Alphabet rose 0.5%, Microsoft dropped 0.54%, and Amazon edged up 0.02%. On economic data, U.S. retail sales in July rose 0.5% month over month, below market expectations of 0.6% and June's 0.9% increase. The University of Michigan Consumer Sentiment Index for August fell to 58.6, below market expectations of 62 and the prior value of 61.7, marking the first decline in 4 months. One-year inflation expectations rose to 4.9%, well above the expected 4.5% and prior 4.4%, while five-year expectations edged up from 3.4% to 3.9%. Key events this week include Federal Reserve Chair Jerome Powell's speech at the Jackson Hole Global Central Bank meeting and the release of the Fed's latest meeting minutes. Additionally, any new statements from Trump on tariffs for specific industries or countries will be closely watched. In Hong Kong, weaker than expected mainland China data on consumption, industrial output, and fixed asset investment led to a decline in the Hang Seng Index last Friday. The index opened 197 points lower, with losses widening to as much as 351 points to a low of 25,168 before closing at 25,270, down 249 points or 1%. The Hang Seng Tech Index fell 32 points or 0.6% to 5,543, and the Hang Seng China Enterprises Index dropped 89 points or 1% to 9,039. Market turnover reached 312.6 billion Hong Kong dollars, up from $270.1 billion the previous day. For the week, the Hang Seng Index rose 1.7%. The China Enterprises Index gained 1.6%. The Tech Index increased 1.5%, marking two consecutive weeks of gains for all three indexes. Southbound fund inflows into Hong Kong stocks surged to a record-breaking 35.876 billion Hong Kong dollars in a single day, including net purchases of 12.79 billion dollars in the tracker fund, 5.356 billion in the Hang Seng China Enterprise Index ETF, 2.177 billion dollars in the Hang Seng Tech ETF, $1.454 billion in Alibaba, $1.407 billion in Tencent, $1.247 billion in Meituan, $392 million in SMIC, $256 million in Xiaomi. Data shows southbound funds have been net buyers of Xiaomi for 7 consecutive days, totaling $3.628 billion, and SMIC for 4 consecutive days, totaling $872 million. Technically, the Hang Seng Index formed a double top at 25,736 and 25,766 and pulled back. Investors should watch whether it falls below the 10-day moving average at 25,080 and 20-day moving average at 25,150. If both are breached, the index may fill the upside gap from last Wednesday between 25,016 and 25,177. A break below 25,000 could see the next support at 24,800. Mainland China's markets opened low but closed high last Friday. The Shanghai Composite Index hit the low of 3,658 and closed at 3,696, up 30 points or 0.8%. The Shenzhen Component Index fell to 11,419 before closing at 11,634, up 183 points or 1.6%. Combined turnover in Shanghai and Shenzhen was 2.2445 trillion yuan, down 34.6 billion yuan from the previous day. For the week, the Shanghai Composite rose 1.7%, the Shenzhen Component gained 4.5%, the Chinex Index surged 8.6%. China's three-horse carriage economic data underperformed expectations. July retail sales grew 3.7% year-over-year, below the expected 4.6%. Industrial output for July rose 5.7%, missing the forecast of 6%. Fixed asset investment for the first 7 months grew 1.6% year-over-year, below the expected 2.7% and marking the slowest growth since September 2000. The urban unemployment rate in July was 5.2%, slightly above the expected 5.1%. In Hong Kong, Chinese brokerage stocks surged. CITIC Securities rose 7.3%. CICC gained 8.5%. China Securities jumped nearly 11%, and China Galaxy Securities climbed 9.5%. On August 14, Asian market turnover reached 2.3 trillion yuan, with margin financing balances exceeding 2 trillion yuan for the second consecutive day after August 13, marking the first time in a decade for such double 2 trillion trading days. Historically, 5 of the 7 such days occur during the leverage bull market in May-June 2015. Brokerages are benefiting from rising market risk appetite, with wealth management and proprietary trading driving growth. In Q2, brokerages and their asset management subsidiaries managed 5.52 trillion yuan, up 3.82% from 5.31 trillion yuan at the end of Q1. Most listed brokerages reported significant profit growth, supported by warming primary and secondary markets. Hong Kong airline stocks also rallied. China Eastern Airlines and China Southern Airlines rose over 5%. Air China gained 3% and Cathay Pacific increased over 1%. The China Air Transport Association recently issued a self-regulatory agreement to curb malicious competition aimed at squeezing out rivals, while short-term capacity increases have outpaced demand recovery. High load factors in the summer travel peak are expected to support ticket price recovery. On the earnings front, SITC International reported midterm revenue of $1.664 billion, up 28% year-over-year, with net profit of $630 million, up 79.7%, and earnings per share of $0.24. We declared an interim dividend of 1.3 Hong Kong dollars compared to 72 Hong Kong cents last year. CITIC Telecom International reported midterm revenue of 4.807 billion Hong Kong dollars, down 1.7%, with net profit of $461 million, up 1.3%, and earnings per share of 0.125 Hong Kong dollars. It maintained an interim dividend of 0.06 Hong Kong dollars. By June 30, its mobile user base grew 13.1% year-over-year to 803,000, driven by an 8.2% increase in postpaid users to over 583,000 and a 28.7% rise in prepaid users to about 220,000. 5G users reached 803,000, nearly 100% of its mobile base, compared to 87.9% a year earlier. Today, several pharmaceutical companies will release earnings, including Hansoh Pharmaceutical, China Biopharmaceuticals, WuXi AppTec, CMS, Kelun Biotech, Tongcheng Travel, Xtep International, Leapmotor, Meitu, GDS Holdings, China Blue Chemical, and Sinopec Oilfield Service. Our stock pick today is RIMAG Group, stock code 2522. RIMAG Group primarily provides medical imaging services, imaging solution services, and RIMAG cloud services in China. It's the only medical imaging platform operator and manager in China that offers diversified imaging services and value across the entire medical imaging industry chain. The company listed on the Hong Kong Stock Exchange on June 7, 2024, becoming the first medical imaging service stock in China. The group's imaging center services aim to address pain points in the medical imaging industry, enabling and balancing the allocation of high-quality medical imaging resources to form a network of chain medical imaging centers. The imaging solution services are designed to enhance clients' ability to serve patients through imaging empowerment solutions. RIPMAC Cloud Services help medical institutions reduce labor costs, standardize workflows, and achieve data-driven management, thereby improving the service capabilities and enhancing the patient experience. Following its successful entry into the capital market, the group will continue to use the funds raised to expand its imaging center network, seeking strategic partnerships and investment opportunities along the industry chain, and consolidate its leading position in China's third-party medical imaging services. Additionally, the company will actively pursue overseas expansion, focusing on integrating its superior imaging solution services to form core imaging service capabilities for international markets, aiming to unlock new growth opportunities. For the year ended December 31st, 2024, the group developed 18 new imaging center projects and successfully operationalized 17 imaging center projects with high quality. As of December 31st, 2024, its medical imaging center network extensively covers 16 provinces, autonomous regions, and municipalities in China, with a total of 106 operational imaging centers, forming a large-scale intensive operational matrix. In 2024, the group established an overseas business division, building a business expansion network covering Hong Kong, Macau, Southeast Asia, and the Middle East and Africa. It adopted a product plus service plus brand trinity model to explore overseas markets. Looking ahead, the group plans to continue developing regional shared imaging centers, strategically selecting regions with relatively imbalanced medical resources for resource integration and prioritized investment. It also plans to further develop specialized medical consortium imaging centers and operational management type imaging centers in regions where image, imaging centers have already been established. In high-tier cities with large populations, high consumption levels, and diverse demand, the group will focus on the refined operation and service enhancement of flagship imaging centers. It will also actively explore strategic cooperation with internet hospitals, example JD Health, to enable online appointment scheduling, with RIMAG imaging centers providing offline examination delivery to broaden patient access channels. Under the guidance of Internet Hospital demand, the group will consider the strategic placement of flagship imaging centers and further deepen the medical consortium business layout of flagship imaging centers, incorporating more small and medium-sized medical institutions in the region into the flagship imaging center service network. This will expand coverage of healthcare institutions (HN) and provide more differentiated imaging diagnostics and imaging solution services. Investment recommendation buy at 18.8 Hong Kong dollars. Target price $21. Stop loss at 100 at $17.7. I do not hold the aforementioned stock.